Hello, everybody. Ed Yardeni here, and my colleague Eric Wallerstein is here as well. And we're going to just spend half an hour with you folks discussing things that are relevant to what we do for a living, which is try to understand the domestic global economy and predict what all that will means for the financial markets. With regards to the topics of the day, there's certainly plenty to talk about. Biden dropped out of the presidential race, so now I guess we'll be discussing Trump 2.0 versus Harris 2.0, or at least a continuation of the Biden policies as they might continue or change under Harris. Eric, you've been looking at something called Predicted on the internet. What is that something that's showing odds on a 24/7 basis, or it's during business hours?
Yeah, you get a daily kind of update. But though it updated over the weekend. So right now, predicted showing about 60-40 Trump to Kamala. It was about 50-50 2 months ago between Biden and Trump. And then since then, Trump's odds based on it's a pretty thin market, but based on betting odds, rose as high as 69%. I think the market is kind of, wait and see what the Kamala campaign looks like in early days. But right now, yeah, it's 60-40.
Is that actually a market where people are placing bets, or it's
I have in fact bet on it before. So yeah, people are trading.
and they're actually making money on it or losing money?
Ostensibly, some people are making money.
Yeah. Okay.
There's a pretty big vig, so
Yeah.
predicted it's making money.
All right. Yeah. Well, there's a lot of polls, and predicted is just one of the many indicators of where this is all going. My sense is that the stock market is basically tuning it all out and just kind of focusing on things that matter more to the market, which is things like earnings and the Fed and valuation. But obviously, as we get closer and closer to the elections, the ultimate winner will matter because it'll be radically different policies. Under Kamala Harris, presumably we'd have more of the same of Biden policies, but she's reputed to be somewhat more leftist and more radical, so that's where the policies might go. And under Trump 2.0, I think we can all agree that there'll probably be an extension of tax cuts. There'll be tariffs, and how all that adds up in terms of inflation in the economy is something that we can discuss along the way. Eric's writing about it for tomorrow's morning briefing, but it's a work in progress, clearly. With regards to the current situation in the markets, we've had a bit of a sell-off, not much. I think we're down like 3% from the July 16th high. I think, there's been a lot of back and forth going on in the markets of late. When the CPI came out on July 11th for June, the number was better than expected, and kind of overnight, the betting markets with regards to what the Fed's going to do went to almost 100% the probability that there will be a 25 basis point cut in the Fed funds rate in September, and that I think precipitated a rotation out of the Magnificent Seven and into small caps, Russell 2000, and so on. And then, so that was on July 11th, and then on July 16th, we hit a record high in the market. The next day, on July 17th, we had the news from the Biden administration that they were thinking about taking some draconian actions against ASML in Tokyo, a Tokyo manufacturer of semiconductor equipment that would make it hard for them to sell to China. And so the market, instead of just rotating, also had a pretty significant sell-off led by technology. Now, with regards to sell-offs, it's my opinion that just based on, not my opinion, but kind of the data record suggests that sell-offs 0 to 10%, are typically kind of garden variety. They don't last very long, and they tend to be more technical in nature. When you get a 10 to 20% correction out of that, in other words, when you're down 0 to 10 and then suddenly you're down 10 to 20, that's an official correction. And in an official correction situation, it usually occurs because investors are fearing that whatever it is that's out there that has got them spooked, that a recession is going to happen. And then a recession doesn't happen. And so it just turns out to be a garden variety correction of 10 to 20%. And then bear markets tend to occur when we go from a sell-off to a correction to a bear market, 20% or more down, when investors conclude that we actually are in a recession, or the odds of a recession, an imminent recession, are quite high. I don't see that the consensus out there right now is that there's a recession imminent. There are still some diehard hardlanders out there who say we're in a recession or soon we'll be at a recession. But that flies in the face of the data. Eric, you've been looking at, you did the calendar for the quick takes for this week, and you've been looking at the GDP data coming up. So we got some macro data. Give us an update on that?
Yeah, we'll get the first read on second quarter GDP this week, and then we'll get the PCED on Friday.
So that's Thursday GDP and
Thursday GDP,
yeah.
Friday PCE. Yeah. Both look pretty good. The Atlanta Fed GDP Now model right now has 2.7% quarter over quarter growth for Q2. And then 2.5% of that is the kind of underlying trend, which is real final sales to domestic private purchasers. Basically, it just excludes net exports, the government, and then I think it excludes those two inventories.
Yeah, so it's demand by real people and real companies.
Exactly. So we have that to look forward to. There will be one more update to the GDP Now after new home sales on Wednesday. And then for the PCED, we already had CPI and PPI, so you can kind of, go from there and see what the PCE might look like. But I know the Cleveland Fed, their inflation nowcast has basically flat for both core and headline month over month, and they see the year over year read down to 2.4%. So down from 2.6% in May to 2.4%, give or take a few decimal points in June. That's, again, meaningful progress down to 2%, which we see by the end of the year. A chart that I've worked up is kind of taking what monthly reads would get us down to 2%. And so as long as we're below, 0.1% monthly increases on the PCE, we're at or close to 2% by the end of the year. And being flat in June would definitely be a meaningful improvement. So things look good on both fronts.
Yeah, and I think we've had a lot of anecdotal evidence that some of the retailers, I was hearing on the radio this morning that McDonald's is going to go nationwide with its $5 meal, and there are a lot of other major retailers that have heard the pain that consumers have been expressing about high prices. And there seems to be some attempt by retailers anyways to cut things down. And the price of gasoline is kind of going nowhere fast. It's going sideways, which is pretty impressive given the geopolitical mess in the Middle East. So, Eric, the bottom line is we've had some actually upward revisions in the GDP, the tracking model from, I think in early July, it was like 1.5%. Now all of a sudden we're at 2.7%. And the news on inflation should continue to improve. So it should all be kind of stock and bond market friendly. So that kind of background leads us to conclude we've been in a sell-off. Market got something like 15% overvalued, if you will, or let's put it this way, it's 15% above its 200-day moving average on July 16th. And now I think we're about 10% above that. And these kind of sell-offs occur from time to time. We don't see a recession out there. We don't think investors are buying into it. And, if there's a recession out there, the Fed has clearly indicated that we've made enough progress on inflation that they can just move forward with lowering interest rates, which would get everybody's juiced up again. Stock market would go up, positive wealth effect. And so the likelihood of a recession is pretty slim in our opinion. Other news that came out today, China decided to lower its interest rates a bit. No surprise to us, the Chinese data has been weak. We've been kind of following the Chinese situation because it's important. It's important not only because it's a major economy, but because it has been a source of deflation for the global economy. Let's see if I can share my screen here. And where did that go? There it is. Okay, so I don't know that Eric and I are going to go through all of our charts here because there's a bunch of kind of interrelated story. But the story I want to start off here is on China. And we've all seen this surge in copper prices that now seems to be reversing. It looks like this was a short covering rally on the NYMEX, on the COMEX, I should say. And so that seems to be reversing. There's apparently still plenty of copper around. The reason that this looked somewhat suspicious is that there was no evidence at all that China's property market issue has been resolved. They've tried to do a few things that haven't really done much of anything in terms of turning the situation around over there. So this kind of makes more sense here, especially since when the price of copper soared like this, the price of oil did not. And we kind of viewed both of these commodities as very key indicators of global economic activity. So here's China house prices. We have the data through June. And so there's been deflation. I suspect the actual deflation is even more in home prices. So there's been a big negative wealth effect in real estate for consumers and also for the stock market. The stock market is down quite a bit there. So this is Chinese stock prices. You can see the CSI 300, that's the blue line, is down substantially over the past several years, big negative wealth effect. And you can see that leading the way down has been this real estate stock price index, which looked like it was getting a bit of a push to the upside, but the trend is still to the downside. So this is sort of our trusty indicator of whether things have bottomed in the property market in China, and that hasn't happened. By the way, I looked at my screen this morning, and on the news that the Chinese were cutting their interest rates, guess what copper did? It went down. So the copper market's not impressed that the Chinese government's doing much to turn the situation around. This is the copper nearby futures contract versus the crude oil nearby futures contract. And as you can see, they tend to correlate pretty closely. And so when we had this divergence with copper going up and oil prices for a while following suit, but then kind of rolling over, we kind of suspected that this was not a sustainable situation and that if this was some people interpreting this as a sign that things were starting to improve in China, that was not in fact the case. So here's real retail sales, inflation-adjusted real retail sales, up only 1.8% on a year-over-year basis. Been very volatile with the pandemic and all that, but you can see before the pandemic, we had high single digits, low double-digit growth in real retail sales. Well, that's just not happening anymore, which makes them all the more dependent on trying to export their way out of it. But the more they export their way out of it or try to export their way out of it, the more deflation they're creating in the global economy, and the more of a headache it is for manufacturers around the world, particularly in places like Europe. We'll look at that in a minute. But we do look at the year-over-year percent change in imports versus exports as an indicator of the global economy in terms of exports. So it's up to 10.7% in current dollars. So that's okay. Global economy is okay. It's not booming. On the other hand, imports are down 0.6%, which is consistent with our view that the domestic demand remains very weak in China. And of course, what happens in China that doesn't stay in China, because it is such a major trade partner for so many countries. And I think one of the reasons that industrial production in the Eurozone has been declining is because of the competition from China. and then it feeds on itself. So if Europe's weak, then the Europeans aren't buying Chinese goods, and so on. What else do I want to cover here? I think that's, well, yeah, we watch commodity prices broadly. This is the CRB commodities price spot price index as an indicator of global economic activity, particularly in manufacturing. And it looked like it was trying to stick its head up, but maybe it's bottoming. But there's no signs that we've got a global economy that's turning hot here. This is another chart of the Brent crude oil price versus the US dollar. And we have a story in here that relates to the, uh, the US energy situation and the dollar as we, well, Eric, you want to kind of chime in here on Trump, what Trump intends to do on the energy front and the dollar and inflation, all that. You're writing about that for tomorrow.
Yeah, so kind of trying to triangulate between the GOP's platform for 2024, which they released recently, and Trump's speech at the RNC, and then things Vance has said, the vice presidential candidate. It seems like their main issue or their main focus has been inflation, which makes sense. Inflation is one of the biggest sticking points for consumers right now and voters. And their primary prescription is lower energy prices. So deregulating the energy industry, unleashing more oil and natural gas, and getting those prices down to help rein in inflation. I mean, on one hand, inflation is already coming down, so that definitely helps. But yeah, I think from a dollar perspective, we've heard from both Vance and Trump that they want a weaker dollar. Lower energy prices would achieve that. One of the stories that Ed wrote was about how as the US becomes a large net exporter of energy, foreigners need to buy dollars to buy our energy. And thus you get a pretty strong positive correlation between oil prices and the dollar. So if we get cheaper energy prices, we would weaken the dollar. Outside of that, there are plenty of dollar up type policies, like tax cuts. If we extend the 2017 tax cuts in full, and or if we lower the corporate tax rate, that necessitates more fiscal spending. The CBO has estimated extending those in full would widen the deficit by $4 to $5 trillion over the coming decade. Of course, it doesn't account for stronger economic growth if you get tax cuts. But of course, that would mean more deficit spending, which all else equal means higher interest rates.
Let's go back to the energy story, because I think that's kind of an interesting one. Is that the U.S. has become a major exporter of energy. We're not there yet in crude oil. I think the net exports are 2 million barrels per day, but certainly in natural gas, we're becoming a major player. We are a major player. And so it's kind of an interesting situation that if we become a bigger and bigger player in the global energy market, foreigners have to come up with dollars to pay for that. That would strengthen the dollar. On the other hand, if all this energy we're producing lowers the price of energy, then that would be a weaker dollar. So it's going to be interesting to see how it plays out. But the House view is that we're not bearish on the dollar. We think the dollar is going to hang in there pretty well. And of course, some of that has to do with relative central bank easing. Other central banks started easing before we did. We haven't actually done it yet, and we might do it in September. And then Eric and I have talked about it, and our conclusion is for now, it's one and done. While other people are talking about maybe 2 or 3 rate cuts by the end of the year, and maybe 5 or to 7 over the next 12 months. We think they've sort of locked themselves into a September cut. But if we're right about the economy and it remains resilient, it may be that they'll just cut it in September and then not do anything immediately after the elections, presidential election results, and then maybe not do anything in December. Just wait until next year to see how it all plays out, because they are going to have to factor in who the next president is and what policies might that might lead to in terms of inflationary pressures. So that's something to consider. Let's go back to the charts. While kind
Yeah,
of,
and I think the rate differential point matters for China too. Like not much came out of the plenum, but I think the reason the markets are kind of unimpressed with monetary easing thus far is because China's too worried about capital flight, given the rate differential and U.S. kind of keeping higher interest rates. So until we ease, China's kind of stuck between a rock and a hard place, and they can't really ease as much
Yeah.
without risking.
Yeah, well, China is basically toast, this is my opinion. They made a mess with the one-child policy, so they got this horrendous demographic situation, and then they made a mess with the property bubble. I think that property bubble is bigger than anything the Japanese did back in the late '80s, and it's bigger than what we did in 2000 in the 2000s. The good news and all that, I mean, we wish them well, but the good news is if they're not doing that well, they might be less bellicose when it comes to their foreign policy, especially with regards to concerns about when they might do something more aggressive than they have so far vis-a-vis Taiwan. But here's that chart again on the oil, and there used to be an inverse correlation between the price of oil and the dollar, but it's become more coincident, and maybe that has something to do with the fact that the U.S. is becoming a bigger player in global energy markets. This is U.S. oil production on a weekly basis, all-time record high. Crude oil field production of 3.3 million barrels per day. This is what I mentioned before. We've now are exporting. This is exports are 10.6 million barrels per day. Imports 8.7 trillion. Net of it is net exports are about $2 trillion, 2 million barrels per day. Natural gas. We've seen natural gas production in the U.S. Base more than double since 2010. And when you look at imports versus exports, you can see that a lot of that extra production is in fact going to exports. We mentioned our thinking on the Fed. Eric and I like this chart. It's kind of a nice, handy way to see on a daily basis the number of expected increases or decreases in the Fed funds rate. And as you can see, when you take this chart, you see that they're looking for 5 rate cuts over the next 12 months. And again, we'll concede begrudgingly that there might be one in September. The reason we're not rooting for a rate cut is we don't think it's really necessary, and we'd like to have like a nice civilized gradual bull market in stocks. And if the Fed starts getting too much into the idea that monetary policy is restrictive and there's long and variable lags, and they've got to cut rates, otherwise they're going to get a recession. That might overheat the stock market more than we'd like to see. We're not rooting for a melt up, but it certainly has felt like a melt up until the past past week, basically. Let's see what else I want to go over. Yeah, we're still talking 4 to 5% on the 10-year bond yield in the scenario we're laying out. It's seems to be trying to hold on to something like 4.25%, which is a natural place for it to try to do that. But we don't think the economy is going to be weak enough to justify falling below 4%. Could be wrong on that. And of course, if we were to see lower rates on concerns that the economy is weaker, the Fed obviously would in fact be easing more than we've been expecting. That would be that would at least avoid a recession, and certainly would potentially create a further melt-up situation in the stock market. A lot of the morning briefing today is really aimed at understanding what the global economy is doing, and this is kind of a experimental chart, if you will, for us. This shows the forward earnings of the S&P 500, all-time record high. This is certainly one of the reasons we've had this bull market. Hasn't been all valuation, and we think from here on it is going to be increasingly an earnings-driven market. But this is S&P 500 forward earnings for air freight and logistics, and they used to track each other pretty closely until here. and kind of wondering whether the divergence might be an indicator of the global economy being relatively weak compared to the domestic economy. So we'll be watching that. It's kind of an interesting correlation. Um, as we mentioned in our conversation, the dollar has been affected not just by what's going on with the global economy and the global the commodity markets, but also how central banks are responding to disinflation. And we've seen other central banks moving more aggressively, if you will. And so that's led to a firming of the dollar. And now the dollar's been somewhat weaker, and the perception that we're finally going to catch up and lower rates. But I think if we're right and it's a one and done situation, then the dollar should remain firm from a kind of a central bank perspective. This is a chart here on net capital inflows, again, vis-a-vis the dollar. You can see that foreigners are still big buyers of U.S. bonds, and this is Treasury agency and corporate bonds, $832 billion over the past 12 months. It's down, but it's still a substantial inflow into the U.S. Of foreigners buying our bonds. And they're also buying some of our equities. I hope they don't get too aggressive because I tend to view them as contrary indicators. They tend to be big buyers right in front of recessions, only to regret it and to reduce their exposure. So we'll see where this thing goes. And finally, with regards to the charts, anyways, this is just a chart of the S&P 500 on a year-over-year percent change versus the net inflows into equity funds. This is domestic equity funds, which includes mutual funds and ETFs. And you can see that in addition to foreigners buying some of our equities, there's plenty of people. They could be foreigners, but a lot of them are probably domestic buying U.S. equity mutual funds and ETFs and equity ETFs. Eric, anything else you wanted to jump in with? I guess we talked about most of the issues that are of importance today. Anything on your mind?
I guess just to reiterate on those last couple of charts, I mean, people sound the alarm that like foreigners are going to stop buying treasuries all the time. That's very much though not the case, and a good part of that chart is that it shows corporate and agency MBS buying, even with an inverted yield curve in the U.S. Foreigners will just go out and buy very high rated corporate credit or MBS, and they'll still get a pickup off short term yields. When they're hedging their currency exposure. So I don't really see any waning demand for our assets.
Let's jump in with the Q&A. And so far, we only have one question from Ian. So, Eric, you and I have been amazingly thorough because nobody's got any questions. But let's see if some people jump on. But Ian says, your thoughts on tax cuts increasing growth and increasing tax receipts over time, thereby mitigating deficit concerns. Total tax receipts are up since Trump administration tax cuts. Yeah, look, this gets into kind of political theory, depending on how you look at things. I'm certainly like the idea from a personal perspective. Cut my taxes, and yeah, I guess that'll get me more money to spend and to invest and to expand our business. So I'm all for lower taxes and less government. But the idea that tax cuts can pay for themselves, that's an opinion. It's not something that we have. It tends to be depending on where you are in the political spectrum. You have different opinions on that subject. Look, I think what everybody agrees on, and we agree, is we are on an unsustainable path with regards to the deficit. And it may, it may resolve itself with better than expected growth based on productivity. But there just isn't really any will in Washington to do anything meaningful on the deficit. So it may, at some point, we may get Ray Dalio's debt crisis, but is not necessarily the end of the world. Instead, what it might do is force the politicians to come up with a kind of a long-term solution that convinces the bond market that over the long run, over a 5 to 10 year period, we will be on the right path. Let's see. Ted says, if China is exporting less, is this inflationary? No, China, the exports are up 10%. So China is exporting more. It's actually deflationary because in order to export more, they're actually lowering their prices to be more competitive relative to European, American, and other producers. So no, they're actually exporting more, not less. Gus, if we do bet some sort of resolution in the Middle East, does that influence your thinking at all? Well, the resolution in the Middle East is, I mean, it hasn't occurred since biblical days. The Crusades are still going on in some fashion. If we're talking about a resolution being a ceasefire between Hamas and Israel, that would, I think, be favorably viewed everywhere, obviously, to end the carnage, or at least for a while, end the carnage. But meanwhile, the situation with Iran hasn't been resolved at all. So I'm not sure that there's going to be any sort of resolution, longer term resolution of anything in the Middle East. Chip, Dr. Y, can you touch on the DXY correlation before and after U.S. oil increases? Why the change and what's the future? Yeah, I think we kind of covered it, Chip. The basic idea is the U.S. becomes increasingly big exporter of energy. People have to pay for it in dollars. That would be strengthen the dollar. On the other hand, if the price of energy comes down because we're producing more, that would be an offset. So maybe on balance, it just leaves us with a dollar firm. Anonymous, can you elaborate your view on U.S. dollar under various scenarios of election results? Is there going to be a Plaza Accord? Yeah, we don't have time for that one, and I don't know that we want to wing it. But we see there's a lot of questions about the dollar, Eric. So you've been addressing it, and we'll continue to address it. Brian, a Trump election is expected to be inflationary, extend the tax cuts, energy, etc. However, if a Democrat wins, the tax cuts would be over. Seems to me that a Democratic victory would likely be depressing, if you will. Thoughts on the policy from the Dems? I guess our conclusion at this time, Eric can disagree, but we do talk a lot, so we do share our views and influence each other. But I think there's just way too many moving parts here when it comes to fiscal and monetary policies, the global economy. Again, a lot of people thought there was going to be a recession because the Fed was raising interest rates, and that the only way to bring inflation down was to have a recession. Well, it turned out one of the things they missed is China in fact had a recession, and that helped to create deflationary pressures in global goods markets. And one of the biggest deflationary forces we've had over the past couple of years is a big drop in durable goods prices on a year-over-year basis over the past several months. I think we'll have to call it quits at this point because it's past our self-imposed deadline of half an hour. Eric, thanks for joining me. Folks, thanks all for joining us, and we'll see you again next week.
Thanks, everyone.
All the best.